various things that the regulator can provide, even in terms of the tax incentives for consolidation. They can drive that, and there were discussions some time back, but it's high time now because we can cut down the expenses. Now, the cost efficiency is some of the key things that the banks are looking at, and that's needed for the revival of the industry.
We have to be very careful in creating a bad bank. The scope should be to rehabilitate and support the industries beyond what the banks can do. And also there should be a way of transferring these customers once rehabilitated back to the banking system.
In a crisis like that, it is necessary to have a financial stability, some sort of fund. So bad bank could be one idea towards that. Recently, after going through this crisis, most of our banks have started rehabilitation units within our banks itself.
Sovereign debt crises and their fallout impact people, businesses, and an economy at large. Often, a country's banks that lend to people, provide business loans, and subscribe to debt issued by governments bear a brunt of the impact. Hello, you're with Echelon's Rocketship experience, and today we are discussing the impact of the sovereign debt crisis on Sri Lanka's banks. And in the studio with us are Sanath Manatunge, who's the Chief Executive of Commercial Bank, Ranjith Kodituwakku, who's the Chief Executive of People's Bank, and Dimantha Seneviratne, who's the Chief Executive of NDB Bank. Sri Lanka's economy is in a challenging environment. We have several challenges on many fronts, and I'll start with you, Sanath Manatunge. Can you outline for us, from the view of commercial banks in general, what shapes and forms the current challenges take on your balance sheet, on your assets and liabilities? Where are you most challenged in your balance sheet?
Yeah. If you talk about the banking industry in general, we had a sovereign downgrade and dollar liquidity dried down in the market drastically.
Sure.
Our counterparty banks stopped lending to us, and also we are an import-dependent economy. We import about 2 billion worth of goods and services per month. With the dollar crisis, the banks had to first manage the liquidity in curtailing imports. So that's first hit in the economy, which we experienced about maybe 1.5 years back. Then when the general economy is deprived of these goods and services, one thing is the inflation went up because of the dollar depreciation.
Sure.
Then rupee liquidity also became an issue because of the treasury bill rates going up. And as banks, so we face two challenges. One is the dollar liquidity, then comes the rupee liquidity. And when the economy is not growing, or we are talking of a degrowth in the GDP. So generally, ultimately the borrowers' issues, like not having enough turnover, then there was social unrest.
Sure.
So everything ultimately ends up in a bank, because
Sure.
they have to service the borrowing at these interest rates. You can't service the loans. So we came just out of a pandemic, the most critical pandemic we ever saw in the world. So the fragile economy had a huge hit in terms of dollar liquidity issues, then sharp depreciation of the currency, and also interest rates. So
Sure.
It's a triple whammy, you would say, right? Interest, exchange, and liquidity. So those are the three, variables which can create a huge risk for a bank. So having issues to the bank is having issue. It will boil down to the economy. So. With this backdrop, if you see what has happened in the country, in the economy for the last 2 years, we expect that, leaving aside the government, the effort to debt restructuring and other things, generally we expect the borrowers to the loan portfolio to be stressed, because obviously, as I mentioned, they didn't have about 3 years bad years they had, not very good years. Because of that, banks are trying to help the customers in maybe rehabilitating, bearing with them with these moratoriums starting from maybe. The bank's moratorium started from the 2019, the incident which happened, then went to
after COVID, yeah.
So many waves we saw, and even with the social unrest, central bank came with certain moratoriums for customers. So those things ultimately the industries, the borrowers should come up with their loan repayment one day. So we have not seen the real stress on the portfolios yet. But having said that, even the interest rate, that higher taxation will deprive of even individuals' ability to repay the loans. So all boiling down to the maybe stressed portfolios in the banking sector in general.
Sure. So Sanath has given us an overview, I think very comprehensive overview of where banks are placed. He suggests that the stress still hasn't shown in the portfolio in terms of NPL, at least, right? NPL hasn't shown. Can I ask, can I start with you, Dimantha, and can you help outline why banks are important to protect in this environment? Like there can be an argument that, okay, everybody's feeling the challenges of the current economic crisis. Why are banks important?
Yeah, just to add to one of the other challenges, and I'll come back to your question. With the steep depreciation of the rupee, other problem that the banks faced with was the capital.
Yeah.
Because all the banks, roughly their balance sheet, if you take 25 to 30% of their book is in dollars.
Sure.
So when the rupee depreciated, the value of that assets in dollar terms actually doubled. Rupee depreciated almost 100%. But our capital is all in rupees. So everybody had that huge impact on the capital ratio.
Sure.
So the capital adequacy ratios were steeply reduced, and we need that capital to even support the revival and the growth. So if you look at, in addition to the three challenges, I would say the capital strain on the capital is also another challenge that the banks are faced with. So getting back to your question about why the banking sector is important, we are talking about 15 trillion assets the banking sector is having, a similar amount of deposits, about 15 trillion deposit, 19 trillion assets, banking sector. And altogether, I think we have more than 3,500 branches supporting the customers, about 56,000 employees working for the banking sector. But more importantly, we are the intermediary activity that we are doing. Mobilizing deposits and funding it to lend to the needy sectors. So that basically drives the economy. So any impact to the industry now, even the savings, people would go and save in the banks or even the finance companies, but mainly the banks. So any impact, the revival of the country depends on how strong the banking sector is.
Right.
So that's where it's important that we need the any country, banking sector to be strong and support. So far, that's where even regulators also come up with certain regulatory forbearance, especially on the capital side. Especially with the steep depreciation of the rupee, the impact on the capital, that's where they have come up with the capital conservation buffer. Now, capital conservation buffers are there when in good times, banks build up that conservation buffer. So our minimum capital ratio is 8.5% on the tier 1. So the regulator has given about almost 200 basis percent leeway for banks to come down over a period of 3 years. So far none of the banks have used it, which is also shows the resilience of the banking sector so far. But as we move forward, the way that the debt structuring might happen, that's where there can be challenges on capital. So
Sure.
For the time being, regulator has given up that forbearance on the capital side, knowing the importance of the sector.
Sure. So, since both Sanath and Dimantha have presented the background to this issue quite comprehensively, now I'll bring you in here, Ranjith, right? How does, it is apparent that the worst of this crisis hasn't really translated into your balance sheets and P&Ls, right? When we step into next year, 2023, where do you see the first waves of stresses coming from, and which of these aspects, we are talking about interest rates, exchange rates, capital and liquidity, which aspects do you think are likely to be the ones most difficult to manage from
yes, Shamin, I think we've just ended up a moratorium period given to most of our customers.
That is after COVID?
After COVID, and also during this year as well. I mean, it's post-COVID reliefs mostly. And what I see is from liquidity, we have already felt the stress, and it will be aggravated once this COVID-related moratoriums are over. So in terms of exchange rate, I would say now it's more or less stabilized. You can see that. So the pressure from exchange rate will not be there most probably going forward, because we've seen that stabilize over the last 5-6 months. If you look at this NPL side, which is going to be the most challenging effect on the banking balance sheets, as I see it, starting from next year once the moratoriums are over. As of end of October, the stage 3 loans are around 11%. So out of, like Dimantha said, 19.3 trillion assets, it's almost above 1.2 trillion right now.
Just to quickly define stage 3, this is an IFRS 9 related classification.
That's
Can you quickly define stage 3 for us?
Stage 3 is loans where you classify for potential risk. So the earlier classification was NPL, which is historical, based on historical data or something. Once the incident happens, you classify it as NPL. In terms of IFRS 9, it's based on your potential risk.
Sure.
So stage 3 loans have shot up beyond 1.2 trillion, which is almost 11%, and it is expected to be go up to 15% in the coming month, which will have a considerable impact on Tier 1 capital in terms of provisioning. So that's where the highest stress will come in my point of view. On top of that, we've already seen that the bank's balance sheets are affected by international sovereign bonds, where most of us have some sort of exposure, on which there will be an inevitable haircut. So if you have seen the accounts published by all the banks, they have taken considerable provisioning, a minimum of 30% to face this challenge, if I say. And but this could be beyond that, because if you look at how the international ISPs traded in the secondary market just prior to this default, there was a haircut about 40%. The expectation is the haircut might go up to 40%. So from there also there could be a pressure mounting in terms of provisioning. That's another aspect I would say. So it's a matter of managing liquidity. I mean, liquidity is of paramount importance, like Sanath explained, because all the banks are going through some sort of liquidity stresses, either from dollar side or the rupee side. So it's a matter of how best you can manage your liquidity, and also in the meantime conserve and augment your capital to face these challenges.
Right. I'll just want to clarify a few things. You talked about stage 3 classification. It's now reaching 11% sector-wide of the book. So this hasn't necessarily, has the provisions already been done for this? Just from a layman's point of view to understand, have the provisions come to the P&L, or will they come over time?
I think it's already taken.
Right.
Most of the banks, so they
Sure.
are like the Sri Lankan banking industry, which is well regulated by the central bank, and they have been very proactive in making sufficient provisions to meet these challenges. If you look at the balance sheets, as I said previously, of declared by all the banks as at end of quarter 3, we can see that substantial provisioning have been made to absorb these losses which will show the proactive measures taken by the banks, I would say.
Right. If I can bring you in, Sanath, right? So we've sort of covered all the big ticket issues that banks are going to face on their P&L and on their balance sheet. Liquidity is the first one that banks seems to have faced. Exchange rate has stabilized, but on the ISBs, right? Let's talk about what you have on the balance sheet. Many banks, including yours, have a lot of international sovereign bonds or Sri Lanka's commercial debt issued in dollars in international markets. There is a negotiation with the creditors. I'm sure you are also in some way part of that negotiation for a haircut. Reprofiling of this debt, can take several forms. Is it fair to think that this is the next wave of the big challenge that banks will face?
Actually, the bank's position is zero haircut, which I don't know whether practically will happen.
That is on the international commercial debt?
Yes,
right.
Because if you talk about the banking sector, although we have made provisions, we are not talking about a haircut. It's a expected loss kind of a provision, and we have retained a financial advisor and a legal advisor. So I don't know how successful we are to curtail the haircuts at zero. I don't think it's practically possible. But our position is the banking sector should be resilient, even to support the restructured bonds. Now the creditors understand that even the restructured bonds to be paid in future, the economy should be resilient and the banking sector should support the economy. So with that view, we are also negotiating and we are talking to the lawyers and financial advisors of government, the central bank, then also the creditors who are outside the Sri Lankan territory. We are talking to them also. So all are in good faith. We are in negotiations. All three parties, government, the outside creditors and the bankers. We have a consortium of banks which we are negotiating for the best solution possible. While having that with the auditors' view, all the banks are providing some kind of a provision for possible potential losses.
So just to understand what is happening is the Sri Lankan banks have appointed their own lawyers and bankers to negotiate in this restructuring.
Financial advisors, yes.
Financial advisors.
Because this is the first time we are seeing something here in the Asian continent, maybe South Asian continent. But our financial and legal advisors, they have many experiences in African countries and also in Caribbean countries, where they have negotiated and has come into a kind of settlement. If you see, settlement is not negotiating to say that we don't want a haircut, we can't absorb this or whatever. Different creditors will have different solutions for this. So the local banking sector is keen to have a solution, maybe few solutions to come up with. One is attractive to the external creditors, some may be attractive for us in the banking sector, so that the debt sustainability is formula, right? We have a $100.9 billion debt. So somehow even IMF is keen to see how we can show a sustainable debt servicing. So in this formula, we are part of that.
Right. Is a differential treatment between Sri Lankan banks and foreign creditors holding this commercial debt an outcome that you're seeing, or do you think it will be the same thing applied to everybody?
No, what we are trying to propose is it should not be the same.
Right.
So let's say, as Dimantha said, the banking sector capital adequacy is under stress. So we have a limit to take a haircut.
Sure.
So then, let's say the haircut is compensated by a rupee bond, which is attractive for a local bank,
sure,
which is not attractive for an investor outside the country. Right? So likewise, there could be different, in other countries there are maybe a few, maybe 6, 7, across the board solutions given to the creditors to pick.
Sure.
So something like that should happen, because one solution fit for all kind of thing is not going to happen.
Sure.
So always, even we are talking to the World Bank, IMF, Monetary Board, all these creditors, the Lazard to Rothschild, and we are trying to come up with the best solution for all. Ultimately, the economy should run after this restructuring, and we should not go for a restructuring kind of a thing which is not going to be sustainable.
Yes, so this debt has to be repayable once it is restructured.
Yes,
we don't want another crisis.
And also, if you are talking about the debt, we have the Paris Club, including Japan, China, India. Those are the bigger kind of debts. And also, we should not forget the rupees. Half of this debt is in rupees.
Sure.
So, these are complicated exercise. And also, we need to generate that much of revenue. It's kind of a cash flow forecast. Whether we are generating revenue and whether that revenue generation can sustain the debt. That's the simple formula we are.
Okay, so when you're, I'll throw this question out, right? When you're looking at these negotiations, and we'll bring the rupee debt also into it, right? There's the dollar debt, there's the rupee debt. From a practical managing your balance sheet point of view and managing your income statement point of view, but mostly the balance sheet, what are the places where the impact comes, right? You will provision, but that is not the end of the impacts. What aspects of your business will be impacted by what happens in the balance sheet?
I think key area would be the liquidity.
Right.
Just to add something on the debt structuring, now on the ISPs, banking sector is holding about between 12 to 14% of the total ISP issues outstandings. So that's why banking sector thought that we need to have a separate advisor working because government is working with Lazard. So we deployed Baker & McKenzie and New State Partners as the financial advisor. Of course, keeping the central bank informed. So we have kept the central bank informed. But it's important that the banking sector is safeguarded here. Because, see, IMF would say, okay, this is the country's financial needs, this is the target you should achieve, and within that, how you structure your debt, agreeing with the Paris Club, non-Paris Club creditors, then these private creditors, who are majority of are presented by Rothschild, then the banking sector creditors, all that debt structuring is up to us, the central bank, the finance ministry, and the creditors. IMF would approve their correction facility of 2.9 billion at the board level, but this debt structuring has to happen. So that's where various countries have come up with various formulas. Now, Ghana recently, we just announced that about what the structuring that they're going to have. So for us, something unique, and as Sanath said, something that it's sustainable. We don't want to go back and have that debt structuring again and again like Argentina. So that's why the banking sector deployed this firm to safeguard that.
From your point of view, is there a preferred option here? ISBs, the international commercial debt, is going to be restructured. It is going to have haircuts. What is a preferred option? What are one or two preferred options?
See, the reprofiling of the ISBs is one. Maybe we all know that the immediate payments are impossible. So the deferment of those payments, maybe certain coupon adjustments. So there are various permutations and combinations, and in that, banking sector is important for this revival. And that's where even the Rothschild, who is represented by Rothschild, where the majority of the creditors are represented, they also agreed that when we had that one-on-one discussions, that the need for the banking sector stability to even for the revival. So maybe a different kind of treatment for the local banks who are holding on the ISP. So at Sanath's mention, maybe a rupee option, which is not appealing to them. But they will.
So that is the most likely option, right? That there will be some sort of a rupee-related liquidity that will come to the banks to make up for.
Not liquidity is kind of Shaminda is kind of.
Replacement.
You replace the dent in the asset portfolio by giving a bond. It's not going to create liquidity because bond trading has been depleted drastically.
It will be a tradable bond.
Tradable bond, but the market depth should revive in the future.
Sure.
And add to what Dimantha was saying, in financial terms, IFRS terms, the day these haircuts are materialize, and when the new bonds or restructured bonds comes, there will be a day one adjustment, right? So day one adjustment should have some forbearance. The banking sector won't be able to maybe get this day one adjustment into their accounts depending on the amount on the first year.
So you have already provided, right, Sanath?
Yes. That
but
is for the haircut.
That is for the haircut, but there could be a further adjustment on day one.
Depending on how they are going to restructure, reprofiling, at what rate they are going to.
Sure.
So it could be zero day one adjustment depending on the solution they are going to provide. But if there's a day one adjustment, I think the chartered accountants, chartered institute and auditors will maybe need to make a call on how to spread it over a period. Now, when this IFRS conversion happened, there was some forbearance.
Sure.
The day one adjustment didn't come to the accounts on the first day.
That is IFRS 9.
Yeah,
yes.
so these are extreme situations. So
Sure.
accounting standards, I personally believe that those have been made for general business conditions.
So just to also gain more clarity, if there is a rupee bond related issue to banks to make up for some of the ISB related losses, you don't anticipate this will cover fully a day one adjustment?
It depends on how the solution comes. If it is, let's say, theoretically, if entire haircut is replaced by a 20-year bond or whatever, there won't be adjustment. And at what rate it's coming is another issue.
And how will that reflect on your capital? Obviously, a provision will impact your capital, which on the international sovereign bonds, any provision impacts your capital. If there is a rupee bond, how, just to get an understanding, is that something you can count for in your tier 1 or tier 2?
Yeah, because the haircut will be reduced by that amount, because we are getting compensated by another instrument, which is an asset. So otherwise it will hit the P&L fully.
Yes.
And the retained earnings, or if there's a loss, it will eat into capital.
Sure.
So, and also the restructured bonds, at what rate and what period they are coming in, is another matter of, because those on IFRS is always NPV, the cash flows. So all these things are contingent to what is going to happen in the future. We can't predict anything, but the banks are prepared, and I think all the banks have done their stress testing. That's why certain capital augmentation plans are in place. Banks are getting ready for that. I think the banking sector as a whole is resilient.
Capital is very expensive right now in the market, right? As a sector, is this a time for you to be looking out to raise new capital, potentially? Is it a practical sort of stopgap solution also for this thing?
I personally don't think this is the time for us to go and raise capital.
Right.
Be a lot of uncertainties, and the cost of capital is very high, especially the tier 1, because any tier 1 contribution, I think all the banks also have foreign investors as well. They would, in their rating assessment, the Sri Lanka is anyway default rated.
Sure.
So I think IMF program should first get announced. So once that is announced, then the people have confidence on the debt sustainability. Probably the second half of next year, or that may be the time that ideally the bank should tap the tier 1 level capital. But for various reasons, the tier 2 level, the banks are raising, and of course at a cost, but that is needed to ensure that the capital ratios are maintained. So my short answer is this is
not the time to raise tier 1 capital. Ranjith, if I can bring you in, we've talked about restructuring the sovereign dollar debt, right? But very clearly there is talk, and it's on the table that potentially Sri Lanka needs to do something with its rupee debt also. About approximately half of Sri Lanka's outstanding debt is rupee, maybe a little less now with the because of the depreciation if you take it in rupee terms, right? These banks hold a lot of bonds and bills, amongst other reasons, to manage their liquidity also, to manage the liquidity ratios they have to meet for the central bank also. So every bank has this. What is the preferred approach on this?
Well, mostly the banks and the funds like EPF and ETF have invested in treasury bonds. So if you are to think about at least a reprofiling or haircut on local debts, I think you have to have serious thoughts before even contemplating about it, because it will have devastating effects on the banking sector.
Sure.
But if you look at the experience from other countries, we've seen that in a crisis like this, there have been some sort of a reprofiling rather than a haircut. So, the problem is we are actually still groping in the dark in terms of ISPs and local debts. We are yet to know as to what is going to happen. It's not clear. I think, though we have had several discussions with the IMF and the other relevant authorities here, it is yet to be revealed. So in that sense, like say if you take IFRS 9, the LCI, I think the expected losses are based on informed supportive evidence.
Right.
We are lack of it.
Sure.
So that's a challenge for all of us bankers.
Just to quickly demystify these two terms, reprofile and haircut. Reprofiling, if I understand it right, is an extension of maturities or something
That's
like that.
right.
A haircut will mean either capital or interest coupon rates will be cut.
That's right.
Okay.
I agree with you.
That's right.
So for us, the challenge is when we try to do the necessary provisioning or try to forecast our future business and balance sheets. Since there's no concrete evidence as to what is going to be happen, then there's some sort of a gray area where we have to make guesses and do provisioning. So that is one challenge from our side. But if you look at what's happened in other countries, obviously, though there could be different solutions for local ISPs, what I feel is there will be an inevitable haircuts on the foreign side, ISPs, and but when it comes to local debts, DDR, restructuring, that is of course we can't rule out. But then again, there is a possibility of certain debt restructuring, which might have a substantial effect on our banking sector.
Whether it is a reprofile or a haircut. I mean, you are suggesting essentially that a haircut is an extreme measure and may hurt the industry.
It is an extreme measure. We want to rule it out actually.
Shavendra, to add to that, as banking sector, we are saying we have zero tolerance on rupee haircuts for few reasons. One is
reprofiling is something you may have to look at.
No, even reprofiling, I don't think, because ultimately the liquidity will not be forthcoming and these bonds will be extended.
Sure.
So if you see a rupee investor in bonds, a bank or even a corporate who has invested, 2 years back the dollar was 200, now dollar is 360. So in terms of rupees, we are having an instrument which is not maybe depreciated by 60-70%.
Sure.
So already the haircut has been, embedded into this. Secondly, if you see the bond holders, not the banks, right? Largest bond holder is EPF. That's public money, people's money. So
about 40% of the bonds are with EPF.
Yes, 30 to 40% is with EPF. The NSB by default, they have to have a particular investment, I think, I can't remember, it's 50 or 60% invested in bonds. It's public money. Those, if you see individually, if I am a pensioner or a depositor of those banks, then my EPF is depleted, my return will go down, then the banking sector will not be resilient to support the economy. And there are so many factors. So by promoting this rupee haircuts, what we are trying to do is we create unnecessary panic in the business circles or in the economy. And maybe the creditors trying to get their part of the settlement bigger. So we should not agree for any rupee haircuts in my personal view, and also it's the view of the banks.
Is a differential treatment an option? Spare the banks of a haircut or reprofiling, but on other bonds and bills you do that?
No, unlikely, and also if you see, ultimately this is Sri Lankan public money going into these bonds, right? So anybody getting a hit will be a hit on the economy. And also the rupees, I don't think there will be an issue in servicing if those are properly, managed, reprofiled or whatever. But if you talk about haircuts, we as a banking sector and on behalf of the public money, I think we have zero tolerance. As I mentioned, pensioners will get a hit. Then the banking sector will get a hit. And also at these rates, we can't continue, issuing bonds also. So ultimately, this, although we see a huge maybe increase in these interest rates in the bond markets, those will settle down in future. So if we are, this debt servicing formula is all about assumptions. So if we come out with a formula with maybe positive assumption for the future, we should be able to avoid any rupee haircuts.
Just to add to that, no, it's all based on this GFN targets, right? And
GFN, define that?
That is the gross financial needs, what the IMF has come up. And even as Sanath mentioned, it's all the assumption of the rate. So at current rate, maybe the sustainability of debt is challenging, and at current rates, we may need that when you put to the models. However, if the rates are stabilized around 15%, we can completely avoid any domestic debt structuring. So now here, by even bringing that thought here, what has happened is market also factor that. Now recent bond auctions and all, yesterday it went at 33% 4 year. Right, so there is a element of doubt, so that has created another premium for that. I think if we can bring these rates down, we can completely avoid that even on the theoretical basis. And just to share, IMF-based restructuring over the last several years, about 100 restructuring of different countries. Of that, 29 countries have touched the domestic debt structuring. Of that 29 countries, 10 of them, banking sector collapse. So that's the gravity of this. So I think whoever who bring that thought also be mindful of these repercussions, not only banking sector, the EPF money. Because these investments are by statute, we are compelled to do. There is a liquidity ratio that the entire banking sector should follow, even in National Savings Bank, by statute, much higher figure. So they have to keep that in the rupee bills and bonds for liquidity purposes. Same with ISBs. Whoever foreign currency liabilities, deposit based, to have the liquid asset, only liquid asset available for the banking sector was either ISBs or the Sri Lanka development bonds. Otherwise, you have to keep it in a nostro account with no return. So and that's where the background is. That's where the banks are compelled to invest. And now talking about domestic restructuring, that would have a huge repercussion. So we have to be mindful of that as well when we discuss this.
To add to that, debt restructuring, we can't get any examples from overseas, because debt profiles of each country, Ghana, I think they didn't have, the banks didn't have any ISBs, right? They were only having the ISB was with only foreign creditors. Sure. So our position is not that. We are in the same issue like creditors as a banking sector. Then if you see Lebanon, 60% or 70% of it was a dollarized economy, and only tourism was the only foreign exchange earner, but all the banks went and invested in dollar bonds, right? So I think we have to come up with a solution which is suitable for Sri Lanka. Although IMF or any other party, come up with overseas example. When I met the financial advisor yesterday, also reiterated we have to have our issue, our case study, as a Sri Lankan case study, and customize the solution to us. We can't say these other countries have done that and this is suitable to us. No, it's not going to happen. And also, I personally feel that sometimes even this formula from IMF or whatever, we should, as a country, we should challenge them and say, no, this is wrong, these assumptions are wrong, these are our calculations.
Are we doing enough to challenge something that is being imposed on us or demanded for by foreign creditors, do you think? Because you're in both conversations.
Yes,
You're in conversations with involving foreign creditors and also in conversations with the central bank and government on local currency.
I believe that the Lazard is doing that for the government.
So I think as an industry, that's where we want to be. So that's where the industry also deployed additional financial advisor and a legal firm to represent the industry. That's on the ISB side. But when it comes to the local debt, if there is a need, I think industry should also form similar alliance and then have that, because it's important that IMF would give their targets, but within that, how you negotiate with the foreign creditors, the domestic creditors, all that is, it's up to each country. So whether we are doing enough, your question about whether doing enough, I would say I think we should do more to ensure that as an industry negotiate harder. So for that we need to have a forum.
As far as the local debt is concerned.
Yeah. Even for the ISBs as well. So that we have already started, so that even the financial advisors are here in the country now. So we are having one-on-one meetings and the combined meetings as well. That's on the foreign debt side. But even if there's hint of local debt, I think that again the industry should work together. That's where not only those banks holding on the ISBs, the banks, the entire banking sector who's holding the domestic debt, then the EPF, I mean, there's going to be public outcry as well. So I think it's up to us how hard we negotiate and get the best deal, sustainable deal for the country.
What sort of time frame are we looking at, Ranjith? I mean, Sri Lanka is desperate to close a deal fast, I think, to bring stability by virtue of having an agreement with the IMF. But I think that is contingent on having the creditors agreed broadly across restructuring. From your conversations, etc., what sort of time frame are we looking at?
Well, if you look at this ISB restructuring, not the local dates, I think Q2 next will be the target time for stabilization. I think we all expect the IMF will seal the deal. By IMF deal will be sealed before that, and the stability will step in from Q2 next year onward.
Is your understanding that without agreement on local debt, that we can agree an IMF package?
In my point of view, as far as I know, IMF has never intervene in local debts restructuring.
Okay.
So it's a matter for the local, the central bank and the bankers to discuss and come to some conclusions as to what we should do about local debts restructuring or rather reprofiling. But their main concern is how best we can service our overseas debts, international sovereign bonds. That's where the IMF comes and steps in and try and help to restructure the ISPs. So their more focus is debt sustainability before giving any sort of assistance to the country. So that is where we are going through that phase. And from the central bank side as well as the finance minister side, they are taking several steps to prove that we are going to have its sustainability to get this IMF bailout, which will not come in at once as we hear it. Maybe it's in several tranches based on the progress we make. So the local debt reprofiling is a topic mostly discussed by people within Sri Lanka, in my opinion. Some suggest in order to sustain these debts, there need to be a reprofiling, but as Sanath and Dimantha explained, I think we are vehemently against it, because we know the impact that is going to have on the financial sector and the stability of the economy.
Yeah, just to add clarity on what Ranjith was saying, timelines. Chamindra, people think generally we are focusing on IMF, right? IMF 2.9 billion is a kind of a bridging, right? So first we have to show them that we are negotiating with Paris Club, China, India, and then we have to show that we have a plan or agreement in principle with these countries for a sustainable debt. Then they will disperse that. And in tranches, right? 2.9 billion is over a period of 5 years, I suppose. And in the first round of these discussions, even the creditors are not being taken into consideration. Right? If you look at Suriname to Ghana to Lebanon, the entire debt restructuring and the country coming into a investment grade rating might take few years, because once the government to government debts are agreed upon, then these negotiations can prolong, right? So still we have not seen even general proposals being openly discussed about these creditors, because those are price sensitive. At the moment, I think the bonds are trading at less than 30 cents. So, which indicates the markets are so maybe very concerned about the debt restructuring in terms of the bonds. So, this bond restructuring and entire thing to conclude in the best case will take at least 1.5 to 2 years, I think, my personal.
Yeah, I agree with him. Actually, in fact, it's a long and arduous journey. It's not easy for us to come out of, we get back to the previous levels. What I was talking about is some sort of a stability once, to set in Q2. But for us to get back to the previous levels of economic freedom, I think it will take more than 2 years.
Let's talk quickly about what the regulator can do to help a sector that is fairly stressed now. Your regulation is primarily risk-based, so you're required to have capital to manage the risks or match the risks that you're taking. So you can decide to run your balance sheet as high risk or low risk, and the capital amounts will differ depending on how you decide to deploy risk. So if the central bank were to intervene and allow you some forbearance, make some of the risk-based capital rules a little flexible. Dimantha has already said that, a 2% adjustment potentially on tier 1 capital is already available for the banks. If you need this, what other aspects do you think the central bank and the government should be looking at in terms of forbearance?
Yeah, I think in the recent past, the central bank has announced few regulatory forbearance, like Dimantha explained. But what I feel is this regulatory forbearance should come in a time like that. In terms of timing of forbearance, like say now, if like we all know that given the stresses in the market, all of us will have to augment our capital. But there's a question: is it the right time? Whether we can do it at a high cost, or whether we should we have some sort of forbearance by giving us about 12 to 18 months to raise our capital and meet the standards. So because if you look at all other market factors, it's not really conducive for everybody to go out to the market and raise capital. So either maybe additional tier 1 or the tier 2 capital, because if everybody goes out, the market might not be able to fulfill everybody's requirement. So in terms of capital augmentation, 1 to 1.5 years regulatory forbearance is what I suggest in my point of view.
I think it's already given in the capital conservation buffer 3-year plan to come to the 8.5 level. So I think that way it is addressed. The one other thing we have to be mindful is the tax contribution the banking sector is giving. Right now, with the new tax rates and all, effective tax rates are about 55%. So whatever the bank's total earnings, 55% ultimately comes to the government revenue base. So that is again an important factor in future debt sustainability as well for the whole country. Other areas that regulatory wise, they've already announced a liquidity wise, in case there's a liquidity support needed. In addition to the window that is available, banks can go and tap that liquidity. Of course, we need to have certain assets pledged to the central bank. No one has still approached, but that facility is there. Then on the capital conservation buffer is there. Other one is on the day one impact. In case there's a ISB restructuring or a domestic reprofiling, day one impact would be a key one. That would also have impact on the P&L of the bank and the capital. So that's where the regulator, then the Chartered Accountants Institute and all have to agree that what has happened earlier in the IFRS move that was there, that over a certain period that we can take it. So that is another area that regulator should get involved. Regulator is also quite active, I think, based on the IMF advice and all. They also have started a diagnostic study of top 10 banks to ascertain various levels of debt structuring and also the credit quality. Earlier we discussed about the potential deterioration in the stage 3 loans, etc. What would be the impact of the capital? So that study has already commenced. Most likely by first quarter those numbers would also be ready. So whatever that discussions with the IMF, with the creditors, hopefully the central bank will also have those data available so that they can put into the models and see what is the impact. And when you have that diagnostic study, in case there's a capital, I think we need to also form certain measures, maybe the ADB or the IFC, or there are other multilateral agencies who should come up. In some countries that has happened, to support the capital in if there's a need. So these are some of those measures that the regulator can take.
Yeah, Dimantha, if I may add that the regulatory forbearance to build up your capital from 1 to 3 years given on the capital conservation buffer. I was referring to the stresses that is stemming from the future market factors and how we can further build our capital. So that we need more time because we can't immediately go to the market and do it immediately. It's difficult.
From this, to add to what Ranjith and Dimantha was saying, the regulator was very proactive in giving this forbearance in reducing the capital and to rebuild in 3 years. I think none of the banks have used that. But the issue is practically, if any bank is using that, there will be degrowth in. They will be very conservative. They will go back to 10. The economy will get that not get that money into the loan book. So I personally believe with this the package of restructuring, if there's some consolidation supported by recapitalization is coming through, it's the best thing because we are having 20 odd banks, 25 or 26 banks. For a country like economy like this, it's maybe too much.
What do you mean consolidation? Obviously, merging between banks, but how can the regulator do or play a role?
Regulator could initiate, and also the let's say with this the debt restructuring, IMF or World Bank can come up in a certain let's say after Asian crisis. In Korea, Philippines, there had been a lot of consolidations. Number of banks have been reduced to about 3 or 4, right? So here also, because that creates resilience itself, because the fragility of the financial sector, finance companies, those should be, should not taken lightly, because if one fails, entire sector, even the bigger banks, can get a huge impact because the customers will lose confidence. So these are time where we can even have some consolidation and some strengthen the financial sector.
Should the central bank or government offer an incentive for that to happen? So some differential treatment or some benefit?
Yeah, benefit and also encouragement by maybe there are a lot of red tapes in Sri Lanka for consolidation. And also, as you said, there should be some incentive and encouragement for consolidation, which is a good thing for the economy. Then the banks, one thing is the cost structures of the banks can go down, and we will have a very resilient banking sector which can support the economy in the future.
My final question will be around creating a bad bank, take the stressed assets from the entire sector and put it into a bad bank. This idea was floated. I'm just wondering what your thoughts on that. Can I start with you, Dimantha?
Yeah, the various countries have that kind of arrangement. So we need to have the legal structure also change to support that, step into the shoes of a creditor, and then how do you manage that? Now, for that bad bank, because you need capital, again, the question of capital formation for that. It's very primitive stage that the idea is mooted, but how we don't know much about how it's going to progress. Getting back to on the consolidation plan, I think that's it be the way forward, and that's where the regulator can also support in terms of encouraging There can be branch closures and all. If there's a consolidation, no point having 2-3 branches in one town if there are consolidations. So various things that the regulator can provide, even in terms of the tax incentives for consolidation, they can drive that. And there were discussions some time back, but it's high time now because we can cut down the expenses. Now the cost efficiency is some of the key things that the banks are looking at. If you look at the cost efficiency ratios, various banks, some are below 30, some are much higher, around close to 70%. So whether you need that, I mean, whether the efficiencies that you bring in, that's needed, because for the resilience of the banking sector, you need that consolidation.
I'm just wondering if this is too much to process. You know, in this crisis, when you're unsure how your balance sheet will look 6 months from now, right? I don't think any of you are fully sure. You know, you will do stress testing, you will do scenarios, but you will have to deal with several scenarios. You don't know. Is this too overwhelming an idea you think to think of, or is this the right time for consolidation?
No, I think parallelly we need to work on that. Because see, getting all your resources, I mean, there's no point duplicating some of the things. So if you look at the country, as I mean, not individually whether we should work on that bank or not that, but if you look at the whole country's need, I think that should be one of the key areas where we preserve capital, efficiencies you are bringing in, and that's needed for the revival of the industry.
Okay, so we'll do quickly some final thoughts.
To add to that, Shanendra, actually, if you see, as Dimantha said, in a locality, you get about 8 to 10 banks, right?
Sure.
There are so many ATMs, right? The country is draining the dollars in these ATMs, the software to everything by duplicating and, catering to the same clientele, right? So, let's say Singapore, they only have about 3 or 4 banks, the economy is huge. So, in that respect, I think we are losing a lot of money from the country also in having so many branches in the same locality. The cost structures are high.
Different IT systems.
Yeah, and also we can invest in future technology in a much upscale level. If there are strong banks, and we can actually transform things faster if we can invest. So about the bad bank, actually, as Dimantha said, we need to have the legal framework ready. Even we don't have Chapter 11 kind of things here. Bankruptcy laws are not, I don't think those are very strong. And on the other hand, the bad bank should not be getting the asset and selling and killing an industry. So we have seen from 2019, none of the industries had a very good, apart from few industries, all had their, difficulties. So if at all, these bad banks should be funded by the banks themselves and also capitalized by maybe World Bank or ADB. Then these should be rehabilitation kind of mindset rather than selling the asset liquidation. Because world over, even when we discussed with World Bank, they said most of the bad banks have failed.
Okay.
Because there's no governance. Sometimes there could be political influences just to push a few loans to this bad bank, and the bank capital eroded. So there are so many case studies. So we have to be very careful in creating a bad bank. The scope should be to rehabilitate and support the industries beyond what the banks can do. And also there should be a way of transferring these customers once rehabilitated back to the banking system. So bank can't run as a commercial bank. So there should be, as Dimantha said, we don't know even 1 or 2% of what should be done in this aspect. When we met IMF also, we told that this is a good way to manage, so the banks can get rid of, maybe park them in the bad bank, and the bad bank to handle this professionally, while we can go on doing the normal lending and businesses. So that there will be support for the economy and also dual support. We are resurrecting certain things and reviving the industries while we go on, funding the normal businesses.
Sure. I'll come to final thoughts. Can I start with you, Ranjith?
Yes, I think, bad bank has been mooted recently and even in the past as well. What I subscribe to what Sanath said, where it should not be aimed at liquidating industries and killing industries. Of course, there should be a revival process. In a crisis like that, it is necessary to have a financial stability, some sort of fund. So bad could be one idea towards that. But recently, after going through this crisis, most of our banks have started rehabilitation units within our banks itself. So it could be this bad bank idea could be a move forward, taking our some sort of stressed assets, and they are where they can try and rehabilitate those assets rather than try to liquidate and kill those industries. So it's a good idea. I wouldn't say we should not rule it out, because in a stress situation like we should have a bad bank, but the objective of that bad bank should be for the benefit and in the progress of the country.
Final thoughts, Dimantha?
I think banking sector is quite key industry that we need the economy to manage. Now, if you look at the September numbers of the entire system, compared to last year, profitability wise, there's an overall 40% drop in profitability year on year, mainly because impairments have been taken. On the other side, huge customer base that we need to take care of. They are in this challenging situation not because of any of their faults, except for few who are willful defaulters, but majority of them mostly because of 2 years of negative growth rate and the COVID and so many other challenges. So we need to also ensure that they survive. So that's where we manage this restructuring unit or the remedial unit, because idea is not to put them into the more difficulties, but also help them and provide helping hand during that. So even to do that, the banking sector should be stable and profitable and capital-wise adequate. So ultimately, it boils down to a strong banking system to even support these customers. So that's important. So that's my final thought. Stability of the system is important for country's revival.
Sanath, finally to you.
Finally, I am very optimistic that the Sri Lankan economy can revive, bounce back, because we are a small economy. If you take, we have 2 billion imports a month, so that is 24 billion, which can be easily funded by 12 billion of dollars of exports. 7 billion of remittances and 5 billion of tourism. That is exactly 24 billion. Then we are talking about this loan repayment about 4 billion. So to revive that, we can develop these industries and and also these are good case study for us to have some long-term view about the economy, political stability, accountability, governance, and also the policy consistency. So we have not learned lessons. And if you see, personally I believe this is a man-made disaster. We have rain, we have sunshine. From 6 o'clock to 6 o'clock we have always kind of summer. Our soil is so good, literacy levels are good, the people want and they love the country. So all these put together, if we have a vision as a country, this is a good experience for us to maybe with some difficulties, some pain, we can revive. But we have to have that vision, how we are going to revive, and we have to have the commitment and also that governance, accountability and the policy consistency, so that we get money into the country, investment in the country. So this 4 billion plus or minus can be a small amount in terms of getting in and making it right. So I am very optimistic. If we have the correct path, we follow the correct path, we can revive fast.
Sanath, Manatunge, Ranjith, Kodituwakku, Dimantha, Seneviratne. That has been a wonderfully insightful conversation. I thank you. Thank you very much.
Thank you.
Thanks for the opportunity.